a little bit about myself. I'm a graduate of the University of Pennsylvania, a former professor at Jefferson University in Philadelphia, and I've been involved in the financial markets for over 20 years. And I just want you to know I'm going to be moving a little bit fast because I want to get through all the material and have plenty of time to show you our workspace. Now, I began trading the futures and Forex markets about 10 years ago. And in my training, what I focused on my thesis was the optimization of multivariable equations. Specifically at that time, being the old guy that I am, the University of Pennsylvania had the only working computer in the world, and it ran on punch cards. But a novel approach to solving multivariable equations was using search algorithms. And Penn also had the premier underwater decompression physiology department in the world. So what I did was work with optimizing underwater decompression schedules. Essentially, it was broken down to a multivariable equation, and it had many, many independent variables, because when a diver does a very, very deep dive, they go down hundreds of feet, and as they go down, they have to switch gas mixtures. There are varying amounts of oxygen and nitrogen, and then there's some inert gases that they put in there. And then when they come up, it's the same issue. Maybe now 40 years later, they go down in some of these in these little submarines, but back then they would go down in a deep sea diver suit. And so the algorithm was called ASOP, the Automated Engineering and Scientific Optimization Program, and that got me interested at looking at things looking at optimizing multivariable equations. So when I became involved in the market, what I did was I looked at price movement as simply the ultimate result of multiple independent variables related non-linearly in an equation. And so what we did here at Rightline was going about the toughest part of it is determining what the independent variables are, and then two, difficult but less involved, is optimizing each of these independent variables. And that's what we've done at Rightline Trading. And some of the results we found are very, very unique and create a platform that's very different from most other people. Now, I just want to talk really quickly about some of the things that we found and some of the naivete that's out there. Remember that over 95% of everybody who starts to day trade loses money. And it's really almost an intolerable statistic. And the issue that I think everybody should ask themselves is, why doesn't one generation of day traders learn from the mistakes of the past generation and slowly build on that 95%? Why is it static at 95%? Why does such a gigantic proportion of people who enter this business as commercial traders wind up busting out and losing their account? And the answer is obvious. Each person is simply repeating the mistakes of the last group. I mean, what commercial traders are doing is taking a priori information that they are told is being effective from the last group and then reusing it without looking for any kind of mathematical verification. And one thing that we looked at was using a stochastic oscillator in Renko bars. Now, a stochastic, it doesn't matter whether it's an oscillator. Oh, an oscillator doesn't matter whether it's a stochastic relative strength, CCI. It doesn't make any difference. But if you understand the formula, you understand that in order for the stochastic to trace out an appropriate percent K line, it needs four numbers: the open, the close and the high and the low of a candle. And if you look at range bars, which we really like and we use, they have all those parameters. There's a high, there's a low, there's an open, there's a close. And we'll talk about whether the stochastic provides any useful information in a minute, but at least it's tracing out an accurate percent K line. But when you use it with Renko bars, there's a high and there's a low, but there's no open and there's no close. And you would really be shocked at how many people use a stochastic to trade a chart looking for precision entries based on a stochastic that is tracing out a line that doesn't work. And this goes back to the basics of having some understanding of the actual formula for the indicator that you're using, and don't take anything for granted just because you've been told it works. A lot of these software developers don't know a thing about what they're doing. Now, the other thing is, does the oscillator or does stochastic actually increase the positive predictive value of your trading? In other words, your entries are going to have a sensitivity, and that's the ability to locate all true positives. I mean, if there's a move and you trade with sensitivity, you want to grab it. The problem with trading with sensitivity is you're going to get a lot of false positives. And then there's specificity, which the object of which is to identify all false breakouts, i.e. identify true negatives, not true positives, but true negatives. And if you trade with specificity, you're going to lose a lot of moves, but you're going to screen out the losers. And so sensitivity over specificity times prevalence equals positive predictive value, i.e. that is precision. And if the software developer cannot tell you what the sensitivity and specificity and positive predictive value is of a trading entry, then he doesn't know anything about the software and cannot represent to you that the software is effective. And to give you an example, how do you use an oscillator? There's a lot of traders that when the market is overbought feel that the bulls are in control. And what they do is they continue to buy each pivot as it breaks to the upside. And that's how they use an oscillator. Another group of traders, they look for stochastic, in this case relative strength, look for oscillator divergence. They look for price to make a higher high, and they look for the RSI to make a lower high, and then they go short. And we all know how often a divergence signal gets run over. But traders can take one of two approaches to trading an oscillator. They can look when the market is oversold to continue to buy because the bulls are in control, or they can look and wait for a divergence signal and look for a reversal in the market. So what we did was we looked at 2 years of market replay data, and we looked at the precision of an entry when we added the oscillator signal, whether it be divergence or whether it be continuing to buy high pivots on an overbought or sell low pivots on an oversold. And what we found is that the oscillator adds absolutely nothing to the precision of a trade. It's an elegant indicator, but when you try to use it practically, it doesn't work. There are other things that define overbought and oversold, and therefore we eliminated it as an independent variable in a whole series of independent variables that we want to optimize in trying to predict price movement. So if you want to use an oscillator, I can promise you it's not going to help you at all in your trading. The other thing is Fibonacci, and I call this the Fibonacci myth. There's so many people that just swear by Fibonacci. Now Fibonacci was he wasn't an obscure mathematician. He was a pretty brilliant guy. And he came up with Fibonacci transformations, and I think he did it in the 17th century. And, they describe the number of rims on a pine cone and the number of edges on a snowflake. And Fibonacci numbers really have very, very neat properties. And you can do a whole lot of uh, really fun work with them. There's a guy on the internet. He's a mathematician, and he puts out videos, and he really does a fun video on Fibonacci. But then some bright-eyed guy or some smart aleck decided that Fibonacci, for some reason, was supposed to predict the future movement of price in a financial market. So we looked, and we looked at Fibonacci on one time frame, and we looked at Fibonacci confluences. And when we did 2 years of market replay, we found that the predictive value of a Fibonacci level is so low that it's not usable. Sometimes they break and sometimes they hold. But that's completely random. And when the areas don't hold for at least 70% of the time, they don't act as support or areas of resistance, then they don't increase the precision of your trading. So Fibonacci is, again, another indicator proposed by many who love it, but who I'm telling you, it does not work, will not predict future price movement. And sometimes these levels will hold, sometimes they won't. And when you have an indicator that works sometimes, that should throw fear in your heart, and you should get rid of it. Because you need an indicator that works almost all the time. And we're going to show you the ones that do. Now, before we get to that, I just want to say that we just completed this, and this was on a, I haven't even made the slide yet. We looked at the moving average convergence divergence, and believe it or not, I was very, very surprised. A moving average crossover for the MACD also has no predictive value. And what we did was we looked at not only MACD based off your trading chart, but we looked at the MACD based on 2 time frames, your trading chart and a higher time frame, combined into one line, and then we looked at 2 higher time frames still. And multiple time frame MACD will do nothing to increase the precision of your trading. Now, you can take my word for it or not, but we looked at this scientifically. And if you do a Nexus search, which brings up all of the world literature on any subject that you want, and you look at day trading, and you look for articles that have looked with scientific rigor at the mathematical value of using these indicators to determine an entry, they've never been done. So everything that you've learned is just simply based on the fact, again, that you've been told that by people who've been told that by people who've been told that by people. And that's why 90% of day traders lose, and that's why 95% continue to lose. It just, the misinformation is passed down from generation to generation of day trader. So what is the predictive value of any indicator that assimilates data from your trading chart only? And what is the predictive value of any indicator that works sometimes but not another? And the answer is zilch. It's 0. Anything that assimilates data from your trading chart is simply going to be moved by price on your chart. And it's price that moves the indicator. It is not the indicator that moves price. So any indicator, and almost everyone uses indicators that assimilate data from their trading chart. They look potentially for longer-term time frames, but they don't use indicators that assimilate data from those longer-term time frames as well. I mean, it's and I know I'm talking fast, but I really want to get to the nitty-gritty. But this is an important preamble for you to understand how we arrived at what's important in getting winning trades. So I lost my train of thought. But anyway, if an indicator assimilates data from price movement on your trading chart, it will not work. Now, we have two forms of trading. We have algorithmic trading and we have discretionary trading. And I don't really want to talk about our algorithmic trader. I want to talk about a discretionary trading, which I call out in the live trading room. So I'm really going to kind of move on. Now, here's one indicator that is appropriate as an independent variable to place in an equation that determines the future price movement of any financial instrument. This is called our background bias. Now, this determines the trend of two higher time frames. And what makes this so powerful is that the background doesn't turn pink because price falls. Price falls because the background is already pink. If you're two higher time frames, now if you're trading a range chart, we use the two higher fib numbers, and that's one value we have found. On a 5 range, we use an 8, and we use a 13 range as our two higher time frames. If your 8 range and 13 range are moving to the downside, and all support to the downside is broken, you get this pink color. There are 3 colors representing a down move and 3 colors representing an up. And this is the most powerful color to the downside. And this has tremendous predictive value in determining the direction of price. And when you see this, you are not going to want to take a long trade. Or if you do, you're going to understand that you're increasing the risk astronomically by trading against two higher time frames, because price is likely to fall, and what you need to do is look for a nice short entry. Remember again, we stick with our dogma. We don't care about price on our trading chart. We want to look at our two higher time frames so that price doesn't create the pink. Pink creates the drop in price. That's an independent variable. If the drop in price created the pink, it's a dependent variable and it's useless. Here's another independent variable. These are called our quant lines. And what these do is they represent correlative markets. And they strongly predict the direction of price on your trading chart. Now, this is bonds. Now, there are 3 markets that are combined into each line. And what these lines do is they're comprised of markets that either fall when bonds go up or rise when bonds go up with a correlation coefficient of 0.7 or greater, i.e. 70% of the time when bonds go up, these markets go up with bonds or they fall with bonds rise. And when that happens, you get a dual green line. Yellow means that the correlative markets are just all moving in separate directions. Red, obviously, is one quant line in which these correlative markets are moving down or up when bonds should move down, but you also have a quant in the upside, so stay away. And when the quant lines are yellow, oftentimes you just see the market move into chop because all the correlative markets are not in sync. Now, really what's happening here is if we look at any financial instrument and look what happens with the big institutions, I mean, the best way to look at it is that they have a finite amount of money. And what happens throughout the course of the day is they just rotate that money around. And it's really a risk-on, risk-off situation. I mean, if risk is on, they're going to be buying stocks and other associated higher risk financial instruments. When risk is off, they're going to be moving into bonds and notes and precious metals. And so what this really tells you is where is price moving? And when both quant lines are green, it's telling you that price is moving into the correlative markets that should go up, so money's moving in, and money is moving out of the correlative markets that should fall, so money's moving out. The sum total of which is money should start flowing into bonds. And you can see that this predicts an up movement in bonds. Now, we don't trade bonds unless we have dual green quants, because we want the correlative markets to tell us that money flow is coming into bonds. Bonds are 31.25 a tick, and it's too risky to trade bonds unless all the independent variables are on your side when you take a trade. You want dual quants, and you want the background bias to be, in this case, you want it to be green. Green means that all resistance to the upside is broken, and we have our two higher time frames moving to the upside. Money is flowing into bonds. Two very strong independent variables to try to increase the precision of your trading entries, and they really, really work. And these work independently of an oscillator, MACD, of all the other, of Fibonacci. I don't care if you have fibs here or whatever, if you have an oscillator here or whatever. When background bias is green and money is flowing in, and your two higher time frames are green, and money is flowing into bonds, all of those other indicators are irrelevant. They are dependent variables, and they have to be eliminated. All they're going to do is obfuscate a true and really effective trading entry. So they may not be moving in the direction you want, and they may keep you out of a good trade or may get you into a bad one. Now, here's another predictor of price movement, and that is market profile. Market profile, though, one market profile is not the same as another market profile. And I'm just going to take the approach that you really don't know what market profile is, although probably a lot of traders in the room do. And this is the point of control, and this is where there's most volume at a given price. So there's the most volume in this given day is at price 37.60. So 37.60 is sort of a magnet. If there's a regression to the mean, it's going to regress back to 37.60 because 37.60 is where most of the volume sits. It's where traders like the price to be, and they're all sitting there with a huge amount of volume. And then really, although this is not distributed as like a bell-shaped curve, it's sort of skewed, but between the two cyan lines is really about 67% of all the volume at price. And if the point of control was right in the middle, which it rarely is, you'd have a perfect bell-shaped curve, with this being one standard deviation up and this being one standard deviation down. Even with this not in the middle, these are two standard deviations apart. Now, the thing about market profile is that all these lines act as powerful areas of support and resistance. What we look to do is take a break and retest and a move up. Right here, this is a break and retest and a move up. Here's a double top and a drop. So these very accurately predict price movement. Now, it's not good enough. The reason why one market profile is not equivalent to another is, remember, we don't want to assimilate data from our trading chart. If we do, then market profile is going to get bumped around, and it's going to get knocked around too much. And so, one single candle that just sits there for a long period of time in the early morning, when market profile has not accumulated significant volume at any given price level, can just bop around your market profile. So what we did was we did a proprietary look back to stabilize it. Now, if you go too many days back, then it becomes like a battleship and it won't turn for you. But if you don't do a few days back, then it just gets shifted around too quickly. So very few market profiles have a proprietary look-back period. What they do is they just assimilate data from your trading chart. And again, that isn't going to work. The other issue is that this calculates the value area high, value area low, and point of control intra-candle. So it moves intra-candle. And you don't want the market profile to jump in front of your trade at candle close. Now, most market profiles calculate the appropriate place at candle close. And then number three is the value area high and value area low are between 67.5% and 70%. Some market profiles are 70, some are 67.5. Some of them are in between. But there's a best number. And we spent a lot of time looking for that best number using a year of market replay data. And ours is set a proprietary distance apart, somewhere in between there. So what we've done is we've optimized market profile. So as an independent variable, this is an optimized independent variable. The distance between the value area low and the value area high is optimal. The number of look-back days is optimal. So the chart moves, but it doesn't get yanked around. And so it's going to have an anchor, and it's going to very accurately predict. Now, sometimes market profile breaks, and sometimes it holds. But in this case, it doesn't render market profile useless because you have to make up a trading rule. And the trading rule is, do you trade into it or you don't trade into it? What we do is we have specific rules as when we believe market profile will hold and when we believe it will break. And there's certain candlestick patterns, there's certain price action and formations that are so powerful, they will oftentimes break market profile. And we've defined those. And that's why market profile remains a very relevant tool. Now, what we have to do is we have to define the trend. Now, I would like to ask everybody in the room, though I can't answer questions right now, but I will go back and answer them at the end, is remember that the positive predictive value of a trade, which is the most important number and must be known on your trading chart, is sensitivity over specificity times prevalence. Now, when is a trade likely to trend to the downside or trend to the upside? So when is it most prevalent to get a trade that runs for you? And that's when the market has set up a trend. If you trade in chop, the prevalence of getting a successful entry and a winner is much lower, even with the same sensitivity and specificity, because it's multiplied by prevalence. And if you trade chop, you're going to wind up losing a lot of money. So you have to clearly define when you're in a trend. The software does. When the 50's down and the 15, this is a proprietary 15-day, you have a trend. And trades are almost always going to break in the direction of the trend. So prevalence of a trending trade to the downside is high, and you have a nice positive predictive value. Now, one very, very strong formation is consolidation. And I don't think that people look at consolidation in the appropriate way, because what they look at it, the way they look at it is a period of low volatility, which it is. But really what's important about consolidation, and the more candles, the better, is that it's trapping traders. You can see you've got all these traders trapped to the downside. Now you have all these traders trapped to the upside. All these the downside, all these the upside, and all these the downside. So the direction that consolidation breaks out is going to determine whether the traders in these 3 red candles all get stopped out, or the traders in these 2 green candles get stopped out. Now, what's so powerful about consolidation is that as these traders get stopped out, they're going to push the trade in the direction that you want it to go. And that's one of the reasons why institutions love to run people's stops. Because as they run them, it gives the trade more impetus in the direction that they want to push it. Us as the poor, beaten down commercial trader, when we get our stops run, actually participate in the institutional move by helping push it in the direction they want it to go. Now, consolidation almost always breaks out in the direction of the trend. And a consolidation entry is one of the most powerful and one of the entries that will break market profile. And there's a consolidation signal. It's actually a software-generated signal. And we have a consolidation indicator. And I'll show you that on a live chart to show you that you don't even have to look for it. Our software finds it for you. And at the appropriate time, it will signal you when to go short. And when the time to go short is when consolidation butts up against resistance to the downside or butts up against support to the upside. It's got to break one way or the other. It's either got to break to the downside or it's got to break to the upside. It can't keep moving sideways anymore because it's right up against this line. It can't move through it. And it's almost always going to break to the downside. That's another independent variable, and it has to do with price action and market structure. Now, these are actually basically things that I'm not really going to go into too much. But, you know, this is just trading with our quant lines. This is the E-mini, which has 3 quant lines and 9 correlative markets, and with background bias. In other words, the green background bias is the best. I don't really have to review this in depth, but this lighter blue tells you that all resistance to the upside is broken on your 2 higher time frames, but the market isn't trending to the upside. So you're in a non-trending market that has a likelihood to go up because all resistance to the upside is broken, but you have no trend. And then the cyan is another up color, which tells you that you don't have all support or all resistance to the upside broken, but you're in a trending market. So this is the most powerful, this is the second most powerful, and this is the least powerful of the biases on the triple quants. Now that's our algorithmic performance, which I don't want to go into. So the goal of right line trading is to combine market structure, multi-time frame always, indicator analysis, always multi-time frame, and always off the higher time frames, not off your trading chart, into a simple platform that's been, I left off the T here, but it's been optimized mathematically to provide you with remarkably accurate trading entries. It just takes patience to wait for the alignment. But if you do, you're going to wind up with really good trades. Now, here's some of the methodology that we employ. We are trend traders exclusively. Now, I've sort of developed one type of counter trend trade. I don't want to even talk about it because it's very, very risky. And it may be that I just boot it out because counter trend trading is extremely hazardous to your health. And the best thing to do is to stay with the trend trades, which goes right back to what the slide. We don't trade top. Nobody can call a top or a bottom. And you're going to see how all in a strong institutionally generated up move, you have all these commercial traders creating a down candle. And they get run over, run over, run over, run over. And on a big move to the upside, you'll have 2, 3, 4 pivots created by down candles, sometimes a couple of down candles. that ultimately trap all those traders to the short side in a big institutional move to the upside, and they're going to get crushed. And we don't trade potential reversals for all intents and purposes because we can't find them. You never can tell when a move is really over. We're beginning to see some good hints, and it has to do with volume falling and the market creating a double top or a double bottom at an area of support or resistance. But even those are very, very dangerous. We do not counter trend trade because it's the institutions with the big money. Today was remarkable how the institutions blew the market around. I mean, crude was way at the bottom, and there were a lot of red candles, people trying to take it lower. The institutions moved in, and they just blew crude up. I mean, crude was trading at about 300 or 400 contracts a minute, and then it's trading at 3,500 to 4,000 contracts a minute, and they're going to run everyone's stops who are even entertaining or have in place a short trade. So we don't counter trend trade. And we're going to also show you what we believe is the only accurate volume indicator that's presently on the market. And I'm going to explain to you why it's the only accurate volume indicator. And we don't trade potential breakouts because we don't know which trades are going to continue and which trades aren't. And there are very, very few indicators that can give you that hint. Now, we do actually trade a potential breakout in very specific instances. And I'm just going to go back really quickly to one slide, and I want to see if it shows it. It doesn't. I'll have to show it to you on the live platform. And we're retracement traders in a multi-time frame confirmed trend with multi-time frame market structure and direction in alignment. Trading retracements and then continuations are extremely effective because we're not predicting that a trade is going to just continue on. And we trade them directly off of support, directly off of resistance. And you're going to see that that is a very important independent variable, and you'll see how we quantify it on our trading chart. What we're trying to do is provide you with software that quantifies risk. You as a trader are going to define your risk tolerance. There are some great trades that don't line up for us, some great trades that don't have background bias, don't have the quant lines, but they have great market structure. You may want to take those, but you will come to understand that those are riskier trades because what the platform does is it defines risk for you, and it defines it on every single entry. And then you have to decide. That's what discretionary trading is all about. And if you're looking for a blue dot go long and a red dot go short system, you will absolutely 100% go broke because they just don't exist. And if they did, the developer would be a multi-billionaire, and he would be in Tahiti. Discretionary trading is difficult. It takes discipline, and you have to learn the system. And even after doing it for 10 years, I have a lot of my own personal problems with discipline. You have to learn to sit on your hands, and you just can't chase the market. Now, here's just a schematic version. And what I wanted to show is a couple of things on this slide. On this move down, you can see the consolidation indicator. In order to have consolidation, you must have 4 candles in a row that have a certain range, and it's 12 ticks on an 8 range. When the candle is close enough to the 15, you're going to get that down triangle, and you're going to take the trade, and the trade's going to break to the downside with tremendous degree of certainty. You have right now, you have 2 of the 3 quant lines to the downside. That's enough to take this trade short. And third, one thing I didn't mention, but now I finally get a chance. Order flow is an important independent predictor of a slot of a successful move. And all we do when the candle is outlined in red or outlined in yellow, order flow and momentum are aligned for you on your two higher time frames. And you see you get another consolidation move right here. This is 1, 2, 3, 4, 5, whoops, 6 candles. Consolidation indicator hits. You set to sell a down close, sell when this candle closes. You already know where it's going to close because it's a range candle. And you're going to trap all these long traders. And this is going to fire out for you. Same thing here. You don't have too many long ones here, but you got a lot more long people in this candle. And that's what we want to do. We want to run these people over. Now, these are trades I took in the live trading room. I really don't want to go into trading right now. Here's an 18-tick trade I took. Here's a 3-tick and a 17-tick. And believe me, if you lose discipline, see, this is a perfect trade to the downside. It's a retracement trade, triple quants on the E-mini, and it went for 19 ticks. Order flow and momentum, the candle surrounded by best background bias for a short, and this is where you're most likely to get your runners. When everything, that's all the independent variables we want, our higher time frames to the downside, all support to the downside is broken, all the correlative markets are red, money is flowing out of the E-mini, order flow and momentum are aligned to the downside on two higher time frames, which is why the candle is outlined in red. Your entry is 1 tick below the close, which will be right here, and you're in all the way to the downside. That'd be 4.75 points in on the ES. Now, don't let me give you the impression for a second that every trade works, because if I told you that, you should shut this webinar off. Not every trade works. Even perfect trades fail. But what you're looking for is a positive predictive value of 85% or greater. So 85% of your trades taken will work, and 15% will fail. If you can achieve that, you will make great money in the market. And of those 15% that fail, you want them to be perfect trades. And maybe an institution drives the trade in the opposite direction. You don't know. Never will every trade work. Here's the same thing. Triple quants, second best up bias, candle surrounded in blue, order flow and momentum are present to the upside, and we take a trade to the upside. Now, the distance between the candle open and the modifier on our 15 is an important independent predictor of success. And you'll see that we have an indicator. On an 8-range chart, we don't want to take a trade that's more than 4 ticks off support to the upside or 4 ticks off resistance to the downside, because if it's floating up here, there's a chance it'll come right back to support, stop you out, and then move up. So you want to trade these tightly off support and resistance. The third thing is the MA diff is the independent variable that defines overbought and oversold, not the oscillator. When the distance between the 50 and the 15 is greater than 18 ticks on an 8 range, that's when the market is oversold. And the way we determine that is looking at when perfect entries begin to fail with a greater frequency. If you're 18 ticks or less, the positive predictive value of your trades remain extremely high. As the MA diff, or the distance between the 50 and the 15, increase, then the predictive value of an entry begins to fall. And remember, it's simply another independent variable that defines risk. If you want to take a trade with an MA diff of 20, maybe the risk is just slightly greater that it'll fail, but that may be risk that you're willing to take, and there's no problem, and you're in. It's just as long as you understand what the risk is on every trade. Here's a trade to the downside. It's breaking with order flow and momentum. Now, you can't tell where the point of control is because it's got to be on the right edge. This is a beautiful trade to the downside. MA diff here is 6. Very small between the 15 and the 50, which is really want to get where you want to trade close to the 50, and that's where you get your runners. This is our NDT platform, and we include this with the sale of any package. And it's really a powerful NinjaTrader add-on. And we have a patent pending on it. It's been pending for over a year. We're waiting for the results. But it gives you the opportunity, if you want to take a long trade, to buy on an up close. And it doesn't make any difference whether you're trading time, tick, or range, or Renko. It's going to get you into the trade with incredible speed and precision. One of the big problems when you're trading tick charts, and I really like tick charts, after range, tick is my second favorite, is if you want to buy one tick above or below the close of a candle. And just one other thing, you should never place a trade intra-candle. It's almost like making an opinion on the market before it has a chance to express itself. You want to take a trade on candle close, and you want to take a trade one tick below a short or one tick above an open, because the high of a candle acts as a very weak area of resistance and the low a very weak area of support. So you want to break one tick above or break one tick below, and this will get you into all the trades. And this is how you can trail the trade. On a long trade, you close on the first down candle. On a short trade, you close on the first up candle. So it really manages your trades. Some people want to close on a close. They can use that button. And some people trading Renko will buy or sell on any close. You can hit that. And you can also configure a pullback. If you want the trade to execute at one tick above and then wait for a one tick pullback to give you a premium on the trade, it all does it electronically with speed that can't be done by hand. So this is a little bit, so now what I'm going to do is I'm going to move to the platform. And what I'm going to show you is going to be a little bit overwhelming. Just hang on one second and I'm going to take down the slides. And I hope I haven't gone too fast. I really haven't. I hope. Because what I really want to show you is our dashboard. But I needed to provide you with this background, or the dashboard isn't going to make any sense to you. Now hold on one second, because you just got a little glimpse of my son there. Bringing up the dashboards, and unfortunately, because the market's dead, we don't have any data. But I'm just trying to bring these up one at a time. Okay. Now these are all the dashboards. Now you could configure them however you want. But let me show you what the dashboard does. This is Garmin. You can do any stocks you want. You can put it right by Garmin, or you can put them all in a row. Remember, you don't even have to show the chart. You can drop the chart and just watch the dashboard. And the dashboard can be made as big as you want. So let's just take Garmin and move it out. It's unfortunate that the market's closed and I can't show you the colors. But you can configure this dashboard as big as or as small as you want. And you can put up 100 stocks and put up 100 dashboards and not project any charts. or make them, this small. And then if there's a trade on Garmin, just bring it up. And when there isn't, just fold it up. How you configure it is really up to you. But let's just take 3, for instance, and show you how the dashboard works and why it's so powerful. If you day trade stocks and you want to watch 100 stocks for an optimal entry, this will give you the ability to do it. The first color is background bias. And you want the background bias to either be green, strongest up color, or pink, strongest down color. You want the quant lines, quant 1, quant 2, quant 3, to be all red or all green. You want the modified 15 we have to be the color of your trade. And then we even have volume. You want to trade with adequate volume. And I'm going to get back to a second to why I think we have the only accurate volume indicator. Then when all of these align, you get an audible alert that beeps once. And right here, this square begins to flash. And it will flash as long as there's a potential trade. Now, I don't want to mislead anybody. This is not a signal to take a trade. It's simply a signal that everything is aligned for the possibility of a great potential long or short trade. So what you would do is bring up the chart, and maybe you're going to have a great trade and maybe you will not. Maybe you have to wait 5 or 10 minutes, but the potential for a great trade is there. And you don't get too many of these alerts because you're looking for a lot of independent variables to align. These are all the important ones. And the few additional ones, if you see this 8, that's the distance the candle is from the modified 15. The MA diff, you want to be 18 or greater. So, I mean, it's very easy to monitor. You take a trade off support to the upside or resistance to the downside. But this does almost all the heavy lifting. And you can create multiple dashboards. And this gave us a great trade this morning off of bonds. And if I would have taken another trade, and I'll show it to you, we would have had 3 unbelievable trades on bonds. We trade 2 markets, the ES and crude. I can't watch bonds and notes. I just watch the dashboard. So this is how it looks on stocks. Now it's going to look exactly the same way on the Forex. I'm going to show you how the Forex looks. Let me disconnect the feed. I have a CQG data feed up. I don't want to have any data feed up. And I'm going to open our Forex workspace. Now it's going to take a minute because the Forex workspace has to open. Now you can see the Forex pair starting to come up. There should be 9. Now all you have to do, what I like to do, is just move this over so I can see that this is the pound dollar. Move this over. I do this in the morning and see that it's the pound Canadian. I'll move that over and see that it's up top too, but I like to see it on the side. You can read it off the top. Same thing that you're looking for here. There's the euro pound. There's the pound dollar. You can trade multiple Forex pairs and just watch the dashboard for an alert. This is going to give you a tremendous signal. Again, not an entry, but a potential entry. Now, if you buy the software, you're going to see the kind of deal. You're going to get 4 90-minute sessions with me. I'm going to teach you everything, all the nuance of how to trade this system So once you get the alignment of all the independent variables, you're just looking for a pullback to support or a pull-up to resistance, and you're going to get yourself one great trade. And how you configure these, you just do it when you open the workspace in the morning. And then I'm going to show you our futures workspace. Let me see if I can close this workspace. I can. Close it. That brings back up the stocks. And then I'm going to switch workspaces over to futures. Now, we would have a stock trading room, except that I'm the only trader, and I can't trade I can't trade futures and stocks at the same time. And I tried it once, and it's too difficult. It takes too much time, and it's much too hard for me to trade futures in the morning and stocks in the afternoon. And so, everyone knows the best moves are usually in the morning. So, we were trading stocks in the afternoon when a lot of the moves were played out, and it was much more difficult to get a trade, and it just wasn't really fair. So we booted that. So let's just hold on a minute. The futures are going to come up. I can hear them ticking away. Now, the futures may actually give us a live dashboard. I'm not sure. Now, with the software, we do all the configuration. You don't have to worry about anything. We're going to show you how to do absolutely everything. That is something you do not have to worry about. All right, here come the futures. Here we are. Here's crude. Now, I don't look at I look at four markets. We trade crude and we trade the E-mini. But I like to look at the bonds and the note dashboard. And I'm going to show you something today on bonds. If I can squeeze it out here. And let me just drop these. And then I just want to talk for 2 seconds about the our volume indicator. Now, right here on bonds is we got a signal. The dashboard is going crazy, and there's your short trade on bonds. Remember, it is 31.25 a tick. There's the consolidation signal right below the value area low. The value area low is really acting as an area of resistance. Now we're gonna assume that a pivot or a volume profile is broken by consolidation. And look how far this bond trade went. It went 15 ticks at 31.25 a tick. And we trade 4 bond contracts. Now, I did take a bond trade. I have to find it. When did I take the trade? Oh, you know what? This wasn't even today. Hold on a minute. Wait a minute. No, it was. See, this is a trade I might not take because there's only one quant. It really, you have to define your risk tolerance. I don't like to trade one quant on an instrument that costs me 31.25, but the dashboard wouldn't signal because it's only going to signal when you have both quants. So you wouldn't get a signal on this entry. And I'm trying to find where the heck that trade was today that I took. Hold on a minute. Here it is. Nope. That doesn't matter. I just want you to see that you get tremendous entries on instruments you don't have to watch. That was bonds. And let me just show you notes. And then I just want to talk really briefly about the volume indicator. There was notes right there. And I think I took a note. It was a bond trade. And right off the dashboard, almost the same time as the bond trade. Well, you know what? That might have been the bond trade. Hold on a minute here. Let me just check bonds. Nope. Both giving you signals very close together. And they often do, because bonds and notes move in tandem. And just let me talk really quickly about the volume indicator, and then I'm going to finish up, and I'm going to look at questions. When you trade volume, when you look at a volume indicator, it usually gives you the bars per candle. Now, when you get bars per candle, you have two independent variables. And the independent variables are time and volume. If I can spell it. Because each bar has to take some finite period of time to form. Let's say you're trading a tick chart. Maybe that tick chart is going to take a longer period of time for a 377 tick or a 610 tick or a 1000 tick to form. So time is a variable, and how much volume is indicated. You don't want two independent variables in an indicator at the same time. So you've got to get rid of time. You want a time-independent indicator that only has volume as the independent variable. So even though we're trading an 8 range, these are all 1 minute candles, 1 minute lines. And when they trade above average volume, they turn from orange to black. So it gives you an idea of when the institutions are coming in and trying to move the market. It gives you an idea of when big volume is coming. You don't care about it on a candle. You care about it on a minute by minute basis. Now the only problem is you can't do a look back, because this is moving in minutes and this is moving in candles. So every 30 bars, it overwrites the one on the extreme right, because there's a lot more minute bars than there are in a day than there are candles. But it's extremely effective, and it's the only volume indicator I know that really assesses one independent variable, and that's volume. And you can set it, if I open it up, at any time that you want. It's contracts per time. And we have it set for 1, which is 1 minute. You can set it for as long as you like. You can set it for 2 minutes, for 3 minutes, for 4 minutes. I mean, if you're swing trading, you may want to see volume per 5 minutes. And I like the moving average to be moved quick, so I have it 15 bars back. You can change that as well. I have all the colors. So that's really it. I mean, it's really the end of the presentation, and I just want to show you really quickly our offer, our special offer, which hopefully you can see. If you hang on one second, I'm just going to make it really easy to see. Let me close the closing Ninja Trader is a lot easier than opening it. Just going to exit it. I'm just going to close it all up. Okay. And let me just go back to the slides. Perfect. And let's go to the bottom one. Now here's our special offer. If I can get the slides to show it. Hold on one sec. All right, here we go. Hold on. And then I'll answer any questions. And I know it's been a long time, and I'm sorry. Now, normally, the dashboard, plus all the software, plus lifetime in the training room, and the NDT platform. I didn't type that in. It's normally $59.99. We're going to take $1,000 off to $49.99. Everything is lifetime, and you're never going to have to pay us another penny. It is just the way we do things. If we do upgrades, we do add-ons, we always get those for free. You never have to pay us anything. To the first 4 buyers, we're going to go to $39.99. And the first 4 buyers will get 4 90-minute tutorial sessions with me. If you're not one of the first 4, you're going to have to look at we have proprietary videos that go through the system. But you're going to spend 4 90-minute sessions with me, and I'm going to teach you how to trade this system. And you are going to know how to work that dashboard if you want to leverage that on 100 stocks, on 25 Forex markets. You're going to be able to get winners, and you'll be able to pull them. So the offer expires tomorrow night at 5, and we've never gone down to $39.99 for it's basically everything we do. And you'll be in the trading room for life and never have to pay us another penny. If you don't make the first 4, it's another $1,000, but it's still $1,000 off. Now, we're at www.rightlinetrading.com. info@rightlinetrading.com is our email, and we're at 855-765-6681. Now, let me just split out the questions. And I'm sorry to keep everyone in here, but I do want to answer questions. Okay, there aren't that many, but let me just go through them here. Let me tell you, Bill, Bill talked about the punch cards. I swear to God, it used to eat the punch cards. So you'd put in like 75 or 100 punch cards, and the program wouldn't run, and then you'd find like a mangled set of punch cards that the computer used to eat. It's absolute. Roy, the Aikimoto cloud is useless because it assimilates data from your trading chart. I think, hopefully, David, you asked the blue quant. I would have to go over it. The blue background bias is not the strongest, and I'm not sure what you meant by the blue quant, David, because the quant lines are either going to be green, yellow, or red. We don't have any blue. Elliott wave is horrible, Johnny. It's horrible. I mean, try to trade profitably with Elliott wave. It's just not possible. And believe me, I swear to you, I've spent a huge amount of time trying to. There's a software package called MT Predictor, which is a really good software package. And they will tell you right up front that 50% of their trades are winners and 50% of their trades are losers. And the way you make money trading Elliott wave is to make your winners bigger than your losers. But that's the best you're going to get out of Elliott wave. That's correct, John. John, John, you bring up a really, really good point. Everybody always talks about the risk to reward. And I get questions about that all the time. John brings up the fact that our on the E-mini, our stop, we trade 4. We take 2 off at 3, 1 off at 4, and 1 off at 10 ticks. If we lose a trade, we lose 4 contracts at 7 ticks. We lose $350. The major upside is $250. So the risk to reward is skewed against us. And here's the thing, John. First of all, you have to take into account the number of winners versus the number of losers. Here's the other thing that's really critical. We determine the ATM based upon the average volatility of the market going back 2 years. And we're constantly adjusting the ATM. In a more volatile market, I mean, people always say, why can't I get an ATM that sets me up for a 2-to-1 reward, double the reward for X amount of risk? Well, the market's got to be able to give it to you. You can't ask for something that's irrational. And if you don't abide by what the market is willing to do, all of your trades are going to lose because your targets are going to be too far. Based on the average true range of the E-mini as we assessed it in the last 2 years, and then again recently, you're not going to get more than 10 ticks on almost 85 to 90% of your trades. If you try to go for further moves, you're going to wind up failing more often. And I like a very conservative ATM. Now, lately, the E-mini has been a real pain in the neck to trade. We go days and sometimes weeks without a loser. And the algorithmic, I think, has one loser on it in 3 months. With the triple quants and everything in alignment, it's a great market to trade. So that's really the reason the risk to reward is the way it is. It's all the market will give us. We must set a 7-tick stop because on a 5 range, your entry has to be 1 tick above and your stop has to be 1 tick below your entry. That's based on market structure. 1 tick below the candle itself, like I said, is a strong area as a weak area support. And we have a lot of trades that go 6 and don't go 7. And I had one today that did that on the E-mini. It went 6, it didn't go the 7th, and came back to give us a nice winner. So unfortunately, that's the constraint. Market structure and what the market's willing to offer us. Unfortunately, I wish it would offer us more. Linda, you can. Just go to the website and sign up. You're more than welcome to. No. John, we do not scalp. Our win rate is based on our ATM. Our ATM on the E-mini is if we hit 3 ticks, it's a winner. If we hit 4, we get more. If we hit 10, we get more. On crude, we got to hit 5 ticks. That's our first target. We have 3 contracts there. It's a $150 trade. So a winner is simply a trade that guarantees we're out at the first target. That's what the percentage is based on. It's not based on a runner. Bill, we found 3. And the correlative markets on the Forex are excellent. They're very strong. The exits, what we do is we trail the trade, Bill. So if you're moving up, you're going to close on a down close, your first down candle. If you're moving down, you're going to close on the first up candle and hope the trade takes out all of your contracts before you get an up candle. So that's how we manage our exits. We try to get that trade. A lot of times I chicken out and move that last stop up and I take a more modest profit. And a lot of times that goes against me. I don't monetize the trade as well as I should. But that's the way the book says that we should trade. Sure, Linda. Like I said, just go up to the website and enroll and you're in. Sonny, you can do that. Absolutely. Your optimal entries, and if you, you're a swing trader. Listen, the dashboard's going to work on any time frame, and it's going to work on any kind of bar. If you want to trade time, you want to trade tick, you want to trade range. If you want to swing trade and hold 2 or 3 days, we'll set your ATM up for you, and we're going to give you. If you want to trade a range, we'll have to look at the stock. We'll give you the average true range. We'll calculate it for you. We'll create an ATM for you. We'll see what your goals are. We have so many templates. We have people who trade daily bars and that hold for days on stocks. So it's really up to you. It absolutely will work. These independent variables have nothing to do with how long you hold the instrument. Yeah, that's right. Trust me. I've dropped the box into a puddle of water. No, you need a data feed, Anthony, just for futures. If you want to trade stocks, you need a kinetic data feed. If you want to trade futures, Forex, I use an FXCM data feed. And if you want to trade futures, I use a CQG data feed. You need a data feed for each of those individual markets. But you can have all three hooked up to NinjaTrader at the same time. But it's either going to be a futures, a Forex, or a stock data feed. And the software will work on all three of those. Yep, I've done it all. It's very, very difficult. So listen, everyone, thank you so much. We're going to send out a copy of the webinar as soon as we get everybody's email address and contact information, which is going to be sent to us, which should be early tomorrow. And we're going to send out some we have from today. We'll send it out tonight. And I really hope you got a lot of information from this, and I hope you'll come aboard. I can promise you, you will not regret it. We're very profitable. For 30 months, we've only had one losing month. And all of the numbers you see up on the website are after commissions. And factoring out commissions is a big knock, because sometimes you want to take 2 or 3 trades and get out. This week, I've not been able to do it. This has been a tough week. And we maybe have a small drawdown. But listen, the goal in a tough week is capital preservation. Preserve your capital. Don't take a big loss. Today we made $385 before commissions, not after. Yesterday we made, I think, about $50 before commissions. And then we had 2 negative days, tiny, tiny negative days. So this is a very rough week to trade. And we may not make a lot of money, but the key is we won't lose a lot. So if we wind up closing the week up $200 or $300, it's not a home run week, but we have 3 more weeks to hit our goal of 1,000 per week. That's really the key, consistency. And that's why for 30 months, we've only taken 1 losing month. Now, some months we made 9,000, and some months we've only made 1,500. And the losing month we had was a $1,500 losing month. But our goal is to consistently make money and consistently push your net equity higher, and in a really rugged market. And let me tell you, the biggest downside to the software is myself. When I don't trade with real patience and cherry pick the best trades is when I encounter some losers. And I took some trades yesterday in the live trading room that I want to throw myself out the window. They were terrible. And we still managed to make money. So it's really just a matter of discipline. And, and if you want those 4 90-minute sessions, just come aboard. I will teach you how to trade. Then really it's based on pattern recognition for you, leveraging the software to its greatest capacity, and patience. It's really all it is. All you need are 2 great winners a day, and you can make between $400 and $500. You just have to wait for everything to align. And I tell myself that every morning when I wake up. So listen, everyone, have a really, really great evening. And we hope to see you. If you have any questions or emails, feel free to email us. And we're more than happy to answer your questions. So take care, everybody, and thank you so much for your time. I know it's late. I'm sure everybody's really tired. So have a wonderful dinner, and take care. No matter what you do, what software you go with or how you trade, I wish you the best of luck. And if you have a question, even if you're not a member, you're more than welcome to call me about anything. I mean, I have people who don't even use our software that call me for questions. I don't mind. Give us a call. I'll be happy to. I'm always here. I'll be happy to take your call. So listen, everybody, take care. Everyone's here. We live here. We have cots here. We're like, what is that movie that just came out? I forgot the name of it, where that guy lives out in a bunker for like a year. And I just saw it. I really liked it. But we're like living in a bunker. So all right, everybody, take care. And hopefully we'll see everybody in the room. So long.